Hello everyone, welcome to the 132nd episode of me learning how to trade in Forex. So in the last episode we went through trading shares and all the lessons above from the I think Trading Academy with the beginner lesson of introducing the financial markets. So we finished off with trading shares, with how our shares traded. Most major shares are traded on the stock market. This is a general term for a global network of specific exchanges where shares are bought and sold. And then we went through the little quiz that's in the actual lesson. So select the right country for the following exchange: LSE, BME, NYSE, TSX. What is a stockbroker? So there's three types of brokers: the full service, advisory, and execution only. And then we looked at what trading times are available throughout the day and which session you should go to if you want to trade. How do shares become listed on an exchange? Companies are either privately owned or public. Private company isn't on the major stock exchange, so you usually have to contact the owners directly to buy shares. Even then, they don't have to sell it to you. However, if the owners want to go public to raise some capital or boost the company's reputation, they must carry out an initial public offering, and then following that, the company's shares are listed on the stock exchange and ordinary investors can buy and sell them. Went through what dividends are. A dividend is the amount of money paid to shareholders representing a portion of the company's profits. And the lesson summary we've gone through is most shares are traded on major stock exchanges. Investors generally need to act through a stockbroker to trade them. An IPO is the first time a private company that offers its shares for sale to the public, and a dividend is a portion of a company's profits. So, now we're on to what are stock indices. So, okay, so what are stock indices? Date is the 11th. So yeah, let's get started then. What are stock indices? You may have already heard of stock indices such as the FTSE 100, the Dow Jones, or the Nikkei 225. Numbers often quoted on the news or in the business section of a newspaper, usually alongside a value saying how much they've moved up or down. But what are they and what do they represent? A stock index is a measurement of of value of a certain section of the stock market. A stock index is a measurement of value of a certain section of the stock market. So a stock index is a measurement of value of a certain section of the stock market. This certain section of the stock market can be an exchange like the Tokyo Stock Exchange or Nasdaq, a region such as Europe or Asia, or a sector: energy, electronics, property, etc. The certain selection can be an exchange, a region, or a sector. The FTSE 100, for example, is a number representing the largest 100 companies traded on the London Stock Exchange. FTSE, an index company. If on average the share price of these companies goes up, then the FTSE 100 will rise with them, and if the share price is full, it will drop. If on average the share price of these companies go up, then the stock index also goes up. If on average the share price of these companies go down, then the stock index also goes down. Got a cheeky little video here.
The Dow Jones, Nasdaq, FTSE 100, three of the major stock indices, a hugely important part of our financial world. Yet a stock index is nothing more than a number representing the top shares from a particular exchange. Take the FTSE 100 for example. It represents the largest 100 companies traded on the London Stock Exchange. If on average the share price of these companies goes up, the FTSE 100 will rise with them. If they fall, it will drop. Now in the US, as well as the Dow Jones and Nasdaq, you also have the S&P 500. In Europe, there's the DAX and the CAC. And in Asia, the Hang Seng, Nikkei and ASX. Most of these are calculated using a capitalization weighted average, which means the size of each company is taken into account. The more a particular company is worth, the more its share price will affect the index as a whole. The Dow Jones and Nikkei, on the other hand, they're examples of price-weighted indices, where shares with higher prices have more influence. That means a stock trading at $100 is giving 10 times more clout than one at only $10. So now you know what stock indices are. How can you trade them? Well, since indices are simply numbers, you can't buy or sell them directly. You have to choose a product that mirrors their performance. Index funds, exchange-traded funds, futures, options and CFDs all do this by tracking the price of the underlying index. And because they're made up of so many stocks, the value is always shifting, meaning indices are often more volatile than individual shares, providing traders with multiple opportunities but also increased risk. So remember, when trading stock indices, it's important to do your research and use risk management tools where appropriate.
Okay. So, why are they important? Stock indices give traders and investors an indication of how an exchange, region or sector is performing. Stock indices give traders and investors an indication of how an exchange, region or sector is performing. The ASX 200, for example, tracks the performance of the 200 of the largest companies in Australia. If the ASX 200 starts to rise, then on average these companies are performing well. A rising ASX 200 tells investors that generally the state of the Australian stock market is improving. And if the Australian stock market is on the up, then more often than not the entire Aussie economy tends to be doing well. So movement in the price of a major stock indices can often give traders an indication as to the health of an entire country. The movement of the price movement, let's just call it the price movement of major stock indices can often give traders an indication of the entire country's health. I was going to say economic health, but I don't think it just includes economy. That's important information when planning your next trade. What are major stock indices? Most nations have one major stock index that represents the largest companies in that country. For example, FTSE 100 represents the UK, DAX represents Germany, CAC 40 represents France, IBEX 35 represents Spain, FTSE MIB represents Italy, Nikkei 225 Japan, Hang Seng for Hong Kong, ASX 200 for Australia, TSX 60 for Canada. However, in the US there are several major indices, all based on slightly different sections of the market. The three main US indices are Dow Jones Industrial Average, DJIA, Dow Jones. One of the oldest and most quoted indices, the Dow Jones Industrial Average represents 30 of the most influential companies in the US. It was first calculated in 1896 and historically was made up of firms involved in heavy industry. Nowadays, this association has been all but lost. S&P 500, Standard & Poor's Rating Services. More diverse than DJIA, the S&P 500 is based on the value of 500 of the largest US shares listed on either the New York Stock Exchange or Nasdaq. It was first used in its current form in the 1950s and today represents around 70% of the total value of the US stock market. Nasdaq 100. Established in 1985, the Nasdaq 100 is based on 100 of the largest non-financial companies listed on the Nasdaq exchange in New York City. It represents firms across a number of sectors, but in particular computing, telecommunications, and biotechnology. Lesson summary. A stock index is a measurement of value of a certain section of the stock market. Major stock indices can give an indication as to the health of the equity market and sometimes the economy of a particular country or region. Most nations have one major index. The US has three: Dow Jones Industrial Average, S&P 500, and Nasdaq 100. So most nations have one major index. US has three. Right, trading stock indices. So, how are major stock indices calculated? Most major indices are either calculated using a capitalization weighted or a price weighted system. So most major indices are either calculated using a capitalization weighted or a price weighted system. Capitalization weighted system. Used by the majority of stock indices, this system takes the size of each company into account when calculating the value of the index as a whole. So, the more a particular company is worth, the more its shares price will affect the index. So, used by the majority of stock indices. This system takes into account the size of each company when calculating the value of the index as a whole. So the more a particular company is worth, the more share price will affect the index. The more a particular company is worth, the more it will affect the more its share price will affect the index. The more a particular company is worth, the more its share price will affect the index. The more a particular company is worth, the more its share price will affect the index. You can tell how much a particular company is worth by multiplying its share price by the number of shares issued. This is called its market capitalization. You can calculate how much a particular company is worth by multiplying its share price by the number of shares issued. This is called its market capitalization. The FTSE 100 is calculated using this method. So if, for example, BP is valued at twice the size of Barclays, any change to BP share price will have twice as large an effect on the FTSE 100 as a similar change for Barclays. Other indices using this system include the S&P 500, Nasdaq 100, Hang Seng, CAC 40, IBX 35 and ASX 200. Price weighted system. This method is based on the actual share price of the companies in the index rather than their overall size. So based on the actual share price of the companies in the index rather than their overall size. So the higher the share price, the more influence that company has on the value of the index. The higher the share price, the more influence that company has on the value of the index. The higher the share price, the more influence that company has on the value of the index. For example, a stock trading at $100 would have 5 times more clout than the one trading at just $20. The only two major indices that use this system are the Dow Jones Industrial Average and Nikkei 225. Question: the ABC index is a capitalization weighted that represents the total value of the following three stocks. Company A has a share price of £1, 10 shares issued. Company B has a share price £2 and 20 shares issued. Company C has a share price £5, 50 shares issued. What is the value of the ABC index in pounds? So first calculate the value of each company. Company A is worth £10 because 1 times 10. Company B is worth £40, so 2 times 20. Company C is worth £250, 5 times 50, so 250 times by plus 40, 290, plus 10, 300. Yeah, value of ABC index, but value of company A plus value of company B plus value of company C. How do you trade stock indices? Since indices are effectively just numbers, you can't buy or sell them directly. There's no asset to own and nothing to exchange. Therefore, to trade on a price per index, you need to choose a product that mirrors this performance. There are several that do this. So you can't buy or sell indices directly. You need to choose a product that mirrors its performance. There are several that do this. These include index fund, a specialized investment fund that attempts to replicate the movement of a particular stock index. You can invest in index funds through a fund manager. So a specialist investment fund that attempts to replicate the movements of a particular stock index can invest in indexed funds through a fund manager. Exchange traded fund. A distinct type of index fund that can be traded like a stock on an exchange. Just like stocks, the price of ETFs can change throughout the trading day as they are bought and sold. Currently, the largest ETF in the world is the SPDR S&P 500, which unsurprisingly tracks the S&P 500. Can be so a distinct type of index fund which can be traded like a stock on an exchange. Just like the stocks, the price of ETFs can change throughout the trading day as they are bought and sold. So the price of exchange traded funds can change throughout the day as they're bought and sold. Currently, the largest ETF in the world is S&P 500. SPDR S&P 500, which unsurprisingly tracks the S&P 500. Yep. Derivatives. Financial products that derive their price from the performance of underlying instruments. Financial products which derive their price from the performance of an underlying instrument. For example, futures, options, digital hundreds, spread bets, or contract for differences. Okay, so lesson summary. Capitalization weighted indices are calculated based on the size of their component companies. Price weighted indices are based on share prices. Stock indices are just numbers, so you cannot trade them directly. You need to use funds or derivatives. Cool. What is Forex? If you've ever gone on holiday and exchanged, say, pounds for euros, then you've participated in the Forex market. Simply put, Forex is how individuals and businesses convert one currency to another. Forex is how companies and individuals convert one currency to another. Forex, also known as foreign exchange, FX, or the currency market, is the largest financial market in the world. On average, over $5 trillion worth of transactions take place every day. That's around 100 times more than the New York Stock Exchange, the world's biggest stock exchange. As well as being traded by individuals and businesses, Forex is also important for financial institutions, central banks, and governments. It facilitates international trade and investment by allowing companies that earn money in one currency to pay goods for and services in another. Rip that video. Who trades Forex? There are a large number of market participants looking to trade Forex at any particular time, from individual trade speculators wanting to turn a quick profit to central banks trying to control the amount of currency in circulation. However, by far the most significant players in the Forex market are the major international banks. Between them, Citigroup, Deutsche Bank, Barclays, JP Morgan and UBS account for around 50% of the global Forex trade. The most significant players in the Forex market are the major international banks. Citigroup 16.1%, Deutsche Bank 14.5%, Barclays 8.1%, JP Morgan 7.7%, UBS 7.3%, Bank of America Merrill Lynch 6.2%, HSBC 5.4%, BNP Paribas 3.7%, Goldman Sachs 3.4%, Royal Bank of Scotland 3.4%, others 24.2%. Why do people trade Forex? Individuals and businesses participate in the Forex market for two main reasons. Speculation. Individuals and businesses participate in the Forex market for two reasons. Speculation. The vast majority of Forex transactions are made simply to make money. This means the person or institution making the trade has no plans to take delivery of the currency. They're just looking to turn a profit on movements in the market. Vast majority of Forex transactions are to make money. With major financial institutions always looking to profit from small changes in Forex prices, many large trades can occur throughout the day. This activity means currency rates are some of the most consistently volatile financial markets in the world, which in turn provides more opportunity for speculators to make money. Purchasing goods or services in another currency. So purchasing goods and services in another currency. Every time a transaction is made between two entities in different regions, a foreign exchange transaction needs to take place to pay for the goods or services exchanged. Transactions such as this happen globally every second of every day. Despite the number of transactions, the amount of currency traded is often very small compared to trades made by large speculators. Therefore, commercial trading tends to not have such a big effect on short-term market rates. Foreign exchange transactions happen every time goods or services between two entities are exchanged. There we go. Despite the number of transactions, the amount of currency traded is often very small compared to trades made by large speculators. However, the amount of currency traded is usually very small compared to trades made by large speculators. Therefore, commercial trading tends to not have such a big effect on short-term market rates. How do you trade Forex? Unlike share trading, Forex is an over-the-counter market. Is an over-the-counter market. This means that currencies are exchanged directly between two parties rather than through an exchange. So the currencies are exchanged directly between two parties rather than over an exchange. Is an over the market market, so the currencies are exchanged directly between two parties rather than over exchange. Rather than through an exchange. The Forex market is run electronically via a global network of banks. It has no central It is run via a global network of banks. It has no central location and trades can take place anywhere via a Forex broker of your choice. This also means that you can trade Forex any time, so long as it's during trading hours in any one of the four major Forex trading centres: London, New York, Sydney and Tokyo. Via a global network of banks. Oh, so that's why the banks can see the trades. So where is it? Never make the first move. Dealer, the Forex dealers. Because the market is run electronically via a global network of banks, so they run the stuff, so they obviously can see like how many like what directions most traders are going for and how much they're putting into trades and stuff. Oh right, I see. So Forex trading hours, April to October, UK time, London, New York, Sydney, Tokyo. So we can see that there's overlaps between the sessions as we've discussed before, and then Tokyo overlaps here again. In practice, that means you can trade most Forex pairs from around 21 or 22 UK time on Sunday to 21 or 22 UK time on Friday, every week. The exact times can vary due to daylight saving time changes in the UK, USA and Australia. Forex trading hours. So how does a Forex trade work? Forex prices are always quoted in pairs, such as AUD, EUR. So Forex prices are always quoted in pairs, such as AUD, EUR, which stands for the Australian dollar versus the euro. This is because if you want to purchase Australian dollars, you need to buy them with another currency, like euros. So when trading Forex, you are simultaneously buying one currency whilst selling another. Each currency in a pair is known by a three-letter currency code. In general, the first two letters stand for the country region and the last letter represents the currency. So taking USD JPY as an example, USD stands for the US dollar while JPY represents the Japanese yen. Cool. Select the right country of the following currency code: AUD, that's Australia; CHF, that's Switzerland; Swiss franc, Switzerland. But I don't get why CH though. JPY, Japan; ZAR, that must be South Africa then. South African Rand. The first currency in every Forex pair is called the base or primary currency. So the first currency in every Forex pair is called the base or primary currency. The second currency is known as a quote or counter currency. Is known as the quote or counter currency. A Forex price indicates how much one unit of the base currency will buy of the quote currency. So, a Forex price indicates how much one unit of the base currency will buy of the quote currency. So if you see the following quote, EUR/USD equals 1.20164, this means €1 is worth $1.20164. Buy of the quote currency. So boom. Whoa, never mind, don't need to go boom boom that big. Go down, okay, there we go. You would buy this pair if you think the base currency, the euro, will strengthen against the quote currency, the dollar. Going long. So this is buying the currency pair if you think the base currency will strengthen against the quote currency. Going short. Selling the currency pair if you think the base currency will weaken against the quote currency. Let me just write, so i.e. more of the quote currency is needed to buy 1 unit of the base currency, i.e. less of the quote currency is needed to buy 1 unit of the base currency. Less of the quote currency is needed to buy 1 unit of the base currency. In the next lesson, we'll take a closer look at the terminology involved in Forex trading. Question: let's say a news story has led you to believe that the sterling will rise against the Australian dollar. You decide to buy £1,000 of GBP USD or GBP AUD at 1.97700, which costs you Australian dollars, 1,977 Australian dollars. A few weeks later, you decide to sell at 1.9980. Which one of the following statements is true, not taking into account commission or any other charges? So, price has risen from 1.977 to 1.998. So that's a, what is that? 998 minus 77. That's a I can't do maths. 98 minus 77, that's a 21, right? That's a 21 pip move. 21 pip move. So, wait, this is, wait, let me just work this out. So, cost that, sell at that, You definitely made a profit. You definitely made a profit. Oh wait, let me see how to calculate his profit. I think I'm being dumb right now. 998. So you made 21 pips worth of profit. 21 pips. Well, I'm being hella dumb right now. Why can't I work this out? So set 1.998. Wait, isn't it just 1,000 times by 1.998? That gets you 1998 Australian dollars minus 1977 Australian dollars, which is $21. You made $21 profit, right? Okay, good. Holy, scared me for a second though. I thought after all the reading I've done, I still don't understand how to calculate profits and loss, but okay, never mind. Whew. So, you sold at 1.9980, which meant you would have received a 1,998 US Australian dollars, so making a 21 US dollar profit. Received. Yeah. Okay, yeah, that makes sense. So, lesson summary. Forex is how individuals and businesses convert one currency to another. The main players in the market are major international banks. So the main players in the Forex market are major international banks. Speculation accounts for the vast majority of transactions. It's an over-the-counter market where trades take place directly between two parties rather than through an exchange. Forex is traded in pairs. You are simultaneously buying one currency while selling another. And the first currency in every pair is a base or primary currency. The second is a quote or counter currency. Cool. Let me just get this diagram as well. Okay. I'm going to leave this episode here then. So in the next episode, we're going to carry on with introducing the financial markets with trading Forex. So thank you all for watching, and I will see you guys in the next video. Peace.